Spread betting and trading on margin. When trading stocks using a normal brokerage company, you must pay the full value of the product you wish to speculate on. This can severely limit your potential gains if your trading capital does not match up to your strategy. Spread betting allows traders to circumvent this using margin. This allows you to trade with only a percentage of your position's total value. Unlike shares, with spread betting, you are only betting on the direction of a market without going near an actual share, and this allows for more flexibility. How margin trading works. Now, if you believe you know what direction a share is going to go, you can place a bet, gambling a chosen amount per penny change in the market, or rather, in the price. For example, you bet that shares in Next are going to go up and wager, say, £10 per penny. For example, if a trader buys 5,000 shares in standard dealing, he or she has to pay the full 5,000 value to do so. In contrast, if you open a spread betting position with £5,000 with a spread betting provider, you would only have to pay between 5 and 15% or between £250 to £750. This deposit, required to open each trade on your account, is known as the margin requirement. Now, this also means that spread betting, being a margin traded product, it allows for much greater exposure for a given deposit. Let's say, for instance, that Next shares are trading at £20 each. Rather than buying 250 shares, you could deposit a margin and have exposure for 5,000 shares. The risk of margin trading. Be aware that with Next shares, trading at £20 and even a £1 movement is only 5%, and at £10 a point, you could be up or down £1,000 pretty quickly. The risk here should be clear. With such generous margins, it might look tempting to take on a much greater exposure, and should the market move against you or your position, it means that you will be still liable in the same way as if you've had bought the shares and paid the full price. So you really have to use judgment and utilize margin with care and trade with disciplined approach so as to avoid any nasty surprises. Margin is there to help you trade responsibly, ensuring that you never overstretch your financial means. After all, the risks are high. If a spread betting trade goes against you, you could lose more than your initial margin deposit. So to avoid enforced closure of your trades, follow a considered financial strategy, or rather, a considered trading strategy, and always employ appropriate risk management measures. For more information, visit www.financial-betting.com.